Have you ever looked at a financial ticker, seen the price of gold, and wondered why physical coins cost so much more? It is a common point of confusion for many retail buyers, who often mistake that benchmark number for a final shelf price. When you see gold prices flashing on a news channel or a trading app, you are usually looking at a reference. This number is derived from the COMEX futures market, which is a standardized hub for institutional and professional trading activity. It is important to realize that COMEX is not a retail store, but rather a massive global clearinghouse for contracts. Think of it like the price of raw wheat on a commodities exchange, which is far removed from the cost of bread. Just as the price of grain does not reflect the labor of a local bakery, the COMEX price ignores physical reality. The futures market deals in paper contracts, representing massive quantities of gold that rarely move between individual retail hands. In contrast, physical gold must go through refining, minting, and certification, each adding significant layers of cost to the metal. When you buy a coin, you are paying for the metal, but you are also paying for the manufacturing process itself. Beyond production, there are also the essential costs of inventory risk, secure shipping, and insurance that the futures market ignores. A dealer must manage the risk of holding that gold while the market price fluctuates during their daily business operations. Comparing a volatile futures chart directly to a dealer's quote is a fundamental misunderstanding of how the global market functions. By recognizing this distinction, we can finally set the stage to explore the complex cost structures behind every physical purchase. Let us break down exactly why those extra layers exist and why they are a necessary part of the gold industry. When you look at a dealer's price, you are seeing a retail product that has been refined to a specific purity. This gold has been cast into a bar or struck into a coin, which requires specialized machinery and skilled human labor. Every step of this journey, from the refinery to the mint, adds a cost that is not captured by a futures ticker. The dealer also has to account for the costs of running a secure facility to store and protect their inventory. Insurance premiums for physical gold are significant, and these costs are naturally passed on to the final retail buyer. If you are buying online, shipping and logistics add another layer of expense to ensure the gold arrives safely. These are not hidden fees or scams. They are the unavoidable realities of moving physical assets across the globe. The futures market does not have to deal with these logistics, which is why its price remains so much lower. It is a digital representation of value, whereas your dealer is providing a tangible, physical asset in your hand. Understanding this gap is the first step toward becoming a more informed and confident participant in the gold market. Many beginners feel frustrated when they see a price discrepancy, but this is simply the nature of the supply chain. Think of the futures market as the wholesale price of the raw material before it is transformed into a product. The dealer price is the final retail price, which includes the value-added services that make gold usable for you. If you ignore these layers, you might assume the market is rigged when it is actually just functioning normally. We want to move past the confusion and look at the specific components that make up your final purchase price. This involves looking at premiums, spreads, and the various costs that dealers must cover to keep their doors open. By the end of this explanation, you will see the gold market as a series of interconnected, logical layers. You will no longer be surprised by the difference between the ticker price and the price on a dealer's website. Instead, you will be able to evaluate the true value of the gold you are considering for your own collection. Let us start by diving deeper into how these futures contracts actually work and why they influence the market. The COMEX exchange is where buyers and sellers agree on a price for gold to be delivered at a future date. Because these contracts are standardized, they are highly liquid and easy to trade in massive volumes every single day. This liquidity is what makes COMEX the primary reference point for gold prices all around the world. However, this liquidity comes at the cost of being detached from the specific physical items you find at a dealer. When you buy a coin, You are buying a specific brand, a specific weight, and a specific year of mintage. The futures market does not care about these details, which is why it cannot reflect the retail market's nuances. A coin's value is tied to its physical form, its historical significance, and the current demand for that specific item. These factors create a premium that sits on top of the base metal price, which is what we call the spot price. We will explore how this premium fluctuates based on market conditions, supply shortages, and even changes in consumer interest. You will learn that a high premium is not always a bad thing. Sometimes it reflects the true market scarcity. We will also look at the role of the dealer in providing liquidity, allowing you to buy and sell gold easily. The dealer provides a service, and that service has a cost that is reflected in the bid-ask spread you see. Understanding the spread is crucial for anyone who plans to buy and eventually sell their gold holdings later on. It is the difference between what you pay to buy and what you receive when you decide to sell. This spread covers the dealer's operational costs and the risk they take by holding gold in their own inventory. If you understand the spread, you can manage your expectations and make better decisions about when to buy gold. We are building a complete picture of the gold market, layer by layer, so you can see the full structure. It is a fascinating system that has evolved over centuries to facilitate the trade of this precious metal. By the time we finish, you will have a clear, calm, and intelligent perspective on how gold pricing works. You will be able to look at any dealer quote and understand exactly what you are paying for and why. This knowledge is your best tool for navigating the market without falling for hype or unnecessary panic. We will continue our journey by looking at the specific factors that influence the premiums on different gold products. From bullion coins to bars, each item has its own unique cost profile that you should understand before buying. Stay with us as we peel back the layers of the gold market to reveal the logic behind the numbers. Let us move forward and explore the details of product premiums and the mechanics of the retail gold market. Now that we understand the basics of the futures market, let us look at why your local dealer's price differs from that ticker. The difference is primarily found in the premium, which covers the tangible costs of turning raw gold into a finished, tradable product. Think of the manufacturing process, refining raw bullion, minting precise coins, and the essential certification that guarantees the gold's purity and weight. These fixed costs are spread across every unit, which explains why smaller bars often seem more expensive per gram than larger ones. When you buy a 1-ounce coin, you are paying for the brand value and the intricate design work, not just the raw metal. Next, we must consider the bid-ask spread, which is often misunderstood by new investors as a hidden fee or a simple profit margin. In reality, this spread reflects the dealer's operational costs, including secure storage, insurance, and the inherent risk of holding physical inventory. During periods of extreme market volatility, the paper price and the physical market price can diverge significantly, creating a temporary disconnect. This happens because the physical supply chain cannot always react as quickly as the digital futures market to sudden shifts in demand. By understanding these mechanics, you gain a practical framework for evaluating your own gold purchases rather than just watching a chart. Instead of focusing solely on the spot price, start asking what specific services and guarantees are included in your final checkout price. Ultimately, moving beyond simple price tracking allows you to see the true value behind your investment, leading to more informed gold ownership. Let us break down the premium further, as it is the most common point of confusion for those new to physical gold. When you buy a coin, you are buying a product that has been minted, packaged, and verified for authenticity by a reputable authority. These steps require labor, machinery, and energy, all of which add value to the raw metal you are holding in your hand. A bar or coin is not just a piece of metal. It is a finished good that carries the weight of its production history. This is why you cannot expect to buy a finished coin at the exact raw material price shown on a futures exchange. The premium is the bridge between the raw commodity price and the retail price you see at your local dealer's counter. It accounts for the cost of minting, which is a significant factor in the final price of smaller, more detailed gold products. Furthermore, demand plays a critical role in how premiums fluctuate, often rising when investors rush to secure physical metal. When demand is high, the cost to source and transport physical gold increases, which is then reflected in the premium. This is a natural market response, not an arbitrary markup intended to deceive the buyer or inflate the cost of gold. Now, consider the bid-ask spread, which represents the difference between the price a dealer sells gold for and buys it back. This gap is necessary for the dealer to remain profitable while providing the service of maintaining a liquid inventory for you. Without this spread, dealers would not be able to cover the costs of secure storage, insurance, and the risk of price drops. If you were to sell your gold back to a dealer, you would receive the buyback price, which is lower than the retail price. This difference is not a loss in the traditional sense, but the cost of participating in a physical, two-way market. It is essential to view the bid-ask spread as a standard feature of any retail market, similar to buying and selling foreign currency. When you see the COMEX price, remember that it is a benchmark for standardized contracts, not a reflection of retail liquidity. The futures market is designed for institutional players, whereas the physical market is designed for individual ownership and storage. These two markets serve different purposes, which explains why they often operate with different price dynamics and volatility levels. A sudden drop in the futures price does not always mean that the physical supply of gold has become cheaper or more abundant. Retail premiums often expand during market stress, reflecting the increased difficulty of sourcing physical gold for the public. This divergence is a clear signal that the paper market and the physical market are responding to different economic pressures. Smart investors watch both markets, but they understand that the price they pay at the counter is a retail transaction. It is helpful to compare the premiums of different products to see how they align with your own investment goals. For example, a generic gold bar may have a lower premium than a limited edition coin, even if they contain the same weight. This is because the coin carries a higher aesthetic value and may be more desirable to collectors in the future. Your choice of product should depend on whether you prioritize raw metal value or the potential for future collector interest. By analyzing these factors, you can make more confident decisions about which gold products best suit your personal strategy. Always remember that the dealer price is an all-inclusive figure that covers everything from refining to the final delivery. It includes the cost of shipping, which ensures your gold arrives safely and securely at your doorstep or vault. Insurance is another hidden component, protecting your investment during transit and while it sits in the dealer's inventory. Payment processing fees may also be factored into the final price, depending on whether you use a bank wire or card. These details are often overlooked, but they are vital parts of the total cost of acquiring physical gold today. When you factor in these services, the dealer's price becomes much more transparent and easier to justify as a buyer. The goal is to move from being a passive price watcher to an active, informed participant in the gold market. This shift in perspective is the key to avoiding the common frustrations that many new gold investors face early on. By focusing on the total value rather than just the spot price, you gain a clearer picture of your investment. You will start to see that the market is not as mysterious or deceptive as it might first appear to be. Every layer of the gold market has a function, and every price reflects a specific set of costs and risks. Once you grasp these layers, you can navigate the market with confidence and make choices that align with your needs. The next time you look at a gold price, take a moment to consider what that number actually represents for you. Is it the raw metal price, or is it the cost of a finished, ready-to-own product in your hand? Distinguishing between these two will save you from confusion and help you focus on the true value of gold. Keep these principles in mind as you continue your journey into the world of physical gold and precious metals. Understanding the difference between COMEX and dealer prices is the first step toward becoming a truly savvy gold investor. With this knowledge, you are better equipped to to handle the complexities of the market and protect your long-term interests. Stay curious, keep learning, and always look beyond the surface numbers to find the real story behind the price. You now have the tools to evaluate the gold market with a clear, calm, and informed perspective moving forward.